Every Opportunity Zone fund needs to file IRS Form 8996 annually. This is the form that determines whether your fund is officially recognized as a qualified opportunity fund and whether you pass the 90% asset test. Get it wrong, and you can face penalties. Get it right, and your fund stays compliant. In this video, I'll walk you through how to fill out this form step by step, including how to self-certify as a QOF, how the 90% asset test actually works, and the new reporting requirements that every QOF manager needs to know about before 2027. I'm Jimmy Atkinson, founder of OpportunityZones.com. Let's dive in. Quick disclaimer, this video is for educational purposes only. I'm not a CPA and nothing here is tax advice. Always consult with your tax advisor before filing any IRS forms. First, who must file and when? A QOF must file Form 8996 in the first year it wants qualified opportunity fund status and every year thereafter. The form then gets attached to the fund's federal tax return, typically Form 1065 for partnerships or Form 1120 for corporations. The form is due by the due date of the tax return, including extensions. One really important clarification, qualified opportunity zone businesses, QOZBs, do not file Form 8996. This form is only for the fund itself. If you operate a QOZB underneath a QOF, the QOZB has no Form 8996 filing obligation. That responsibility sits entirely with the qualified opportunity fund. Now, Form 8996 does two things. First, it allows an entity, usually an LLC, to self-certify as a qualified opportunity fund. Second, it reports to the IRS whether the fund satisfies the 90% asset test. And if not, the form will help calculate penalties owed. If you're a partnership or corporation formed to invest in qualified opportunity zone property, you must file this form annually. And one other important distinction, Form 8996 is the form that gets filed by the qualified opportunity fund. Form 8997 is filed by the qualified opportunity fund's investors. So if you're merely an investor in an OZ fund, you're watching the wrong video. Watch our video on filing Form 8997. But if you're a fund manager operating a qualified opportunity fund, you're in the right place. Form 8996 is for you. So here it is, IRS Form 8996. But before we start filling it out, there's one structural concept that you need to understand because it determines which parts of this form will apply to your fund. Almost all qualified opportunity funds do not own property directly, but instead they use a common two-tier structure in which the qualified opportunity fund holds an ownership interest in a qualified opportunity zone business, the QOZB, and then the QOZB owns and develops the actual underlying assets. In this structure, the QOF's qualifying asset for the purposes of calculating the 90% asset test is its partnership interest or stock in the QOZB, not the actual property itself. And this is the path that most OZ real estate funds take, and it's the path that this video will focus on. But there is an alternative. A QOF can directly own QOZB business property directly without going through a QOZB. And in that case, you'd use Part 5 of this form instead of Part 6. If I can just scroll down here to page 3, this is really where this determination needs to be made. This is a less common structure. Typically, a QOF would not hold property directly, so we won't be going deep on it today. But one more important thing to understand before we dive in, this form also gets filled out somewhat in reverse order from how it appears on the page. We'll fill out form Part 1 first, but then Part 2, the 90% calculation, sits on the front page, but you can't actually fill that part out until you've completed either Part 5 or Part 6 on page 3. So Part 6 is really where you report the value of your QOZB investment by census tract, and then those totals get carried back into Part 2. You'll see in a moment here. So the actual completion order is Part 1 first, then Part 6, then Part 2, then Part 3. So just keep that in mind as we walk through it. A couple other things I want to note before we get into how to fill out the form. I did want to flag some important changes on the horizon because if you operate a QOF, these will affect you. Form 8996 is going to evolve. This is the revision from December 2021. This is what the form looks like in 2026 for the 2025 tax year. It's been a few years since this form's been updated, but first, the IRS has already announced that the instructions will be updated to reflect new guidance under Notice 2025-50 pertaining to the substantial improvement standard for certain rural opportunity zones, which reduces the improvement requirement from 100% of basis to just 50% for qualifying rural properties. That change will affect how some QOFs determine whether property qualifies for purposes of the 90% test. But there's more. Congress has also enacted new fund-level reporting requirements pursuant to the enactment of the One Big Beautiful Bill Act of 2025, the new OZ 2.0 reporting requirements. And we're still waiting on new regulatory guidance and a revised version of this Form 8996, but it is highly likely that future versions of the form will require more detailed disclosures, including collecting the NAICS codes of every qualified opportunity zone business that the fund invests in, the number of new residential units that the fund's investments create, and employee headcounts. Most likely, these expanded reporting requirements will begin affecting 2026 tax years filed in 2027. But if you operate a QOF today, that means reporting is going to become more detailed in the near future, and record keeping is going to become more important. So now with that context in mind, let's actually walk through the current form. At the very top here, you just enter the name of your QOF, and we'll just say Acme QOF1 LLC, and the employer identification number is the identification number for that particular entity. So we'll just say it's all 8s for our purposes today. Type of taxpayer, the vast majority of the time, a QOF is organized as a partnership. It could also be a corporation, but most of the time it's a partnership, so that's what we'll say there. Part 2 is just getting at, is this form for you or not? If you're not a QOF, don't fill out this form, and you can stop watching this video. But if you are, you would click yes, and then go to line 3. Now, line 3 is where it gets kind of interesting. In the first year that you elect your entity to be treated as a QOF, you need to tick the yes box here. You will need to file this every single year that this entity exists as a QOF. So in all future years, you would say no, but I'm going to run through this example as though this is our qualified opportunity funds, the Acme QOF's first year as a QOF. And then line 4, also an interesting choice to make, provide the first month in which the fund chose to be a qualified opportunity fund. And this is a really strategic decision that a lot of QOFs need to make. One timing nuance worth knowing, if your fund is set up in the second half of the year, between July 1st and December 31st, you won't have a mid-year testing date in that first year. The first 6-month columns on the form on the subsequent pages just won't apply, and you leave them blank. Your first 90% asset test will happen at year end only, which can be somewhat advantageous, especially considering that newly contributed capital to a qualified opportunity fund can be disregarded for the purposes of determining what the denominator is or the total assets held in the fund. So it buys you a lot of time. For instance, in an extreme case, you could set up your QOF on July 1st of a particular year. You essentially, and fund it on that date. You essentially would not have to meet a mid-year test since you're already in the second half of the year. Your first asset test would happen December 31, but you can disregard newly contributed capital. So really, there isn't a test that date that you need to comply with. Your first true 90% asset test wouldn't actually occur until June 30th of the following year, buying you 364 days to comply. So I'm just going to put in July is the first month in which the fund chose to be a QOF. I think that's probably the most, maybe just one of the most, if not the most popular months to start a QOF for that purpose there. Now, in part 5 here, if any of your investors, or I should say line 5, in line 5 under part 1, if any of your investors dispose of any equity interest in the fund, you do need to tick yes and then attach a statement with some additional information. But we're going to go through a relatively simple example here and say no, we just set up, we just have a couple of investors in this fund, nobody has redeemed any of their interests yet. So part 2 is that 90% asset test calculation. And you may recall, we actually don't do this part first. We want to skip ahead to page 3. Part 2, we calculate the 90% asset test. Part 3, we calculate any penalties if we had any shortfalls. and missed that 90% asset test. Part 4 also helps you compute that penalty, so we can skip this one for now and go straight to page 3. Page 3 is where you would find parts 5 and parts 6. There's also a part 7 on page 4, which is really just a continuation of part 6. And we're going to skip page 4 for now because we're going to use a very simple example where we don't need all this additional information here on the back of the page, so to speak. As I mentioned earlier, the vast majority of qualified opportunity funds are organized under a 2-tier structure where the qualified opportunity fund itself does not hold property directly. In some cases, the qualified opportunity fund does hold property directly. And if that is the case for your particular QOF, you would need to fill out part 5 here. But I'm going to consider a more simple and more common example in which a qualified opportunity fund holds interests or stock in a qualified opportunity zone business, that subsidiary structure that lies underneath the QOF. And then it's within that QOZB. That QOZB is the actual owner of the asset or assets that the fund holds through the subsidiary. So we're going to take a case of that 2-tier structure, part 6 here. We need to fill out for every single line. We would fill out the census tract number. It's an 11-digit number. And then also the EIN of the qualified opportunity zone business. I would note here that a qualified opportunity fund can invest in multiple QOZBs. So you would have a different line for every QOZB that the fund holds. And then a QOZB can hold assets in one or more census tracts. So for every individual census tract that the QOZB holds property in, you would list the same EIN here in column B, but you would list a different census tract in column A. You could also have multiple QOZBs that hold assets in the same census tract. So if that's the case, you might have the same census tract repeated here several times, but an EIN of several different QOZBs. We're going to keep it pretty simple. I'm just going to fill out one line here just so you can get a sense of what's going on. By the way, if you have any non-QOZB property, you would fill out all 9s as the census tract number, but we'll put in a fake but different census tract number. It's an 11-digit number, so we'll go 1, 2, 3, 4, 5, 6, 7, 8, 9, 0, 1 as this census tract, and then the EIN, we'll say it's all 7s. Oops, all 7s for this one here. Now, columns C, D, and E pertain to the value of the investment, owned property, and leased property in the first 6-month period of the tax year. So if you are a QOF that is not in its first year, you would need to fill these out. In my case, remember, we ticked the box up here in part 1 that this is our first period that the taxpayer is a QOF. This is our first tax year in which we are electing to be treated as a qualified opportunity fund for tax purposes. And we also didn't begin our qualified opportunity fund until July. So we were created in the second half of the year. That means in that case, we actually would just leave C, D, and E blank because it pertains to the 6-month period. The instructions do say leave blank, not to put zeros, but just leave blank. So we'll leave them blank. So then we would actually just move straight on to columns F, G, and H here under part 6. And we would fill out the value of the QOZB stock or partnership interest held on the last day of the tax year, apportioned to each QOZ. Okay, so that's the total value of our ownership in the QOZB. And I'm going to use an example here of $1 million. All right, and then in columns G and H, this is actually really interesting because it doesn't pertain to the QOF's interest in the QOZB, but rather the QOZB's value of property that's held on the last business day of the particular tax year. So this could far exceed $1 million if a QOZB has capital from other sources or even from other qualified opportunity funds. In our case, I'm just going to assume we're the sole owner of this QOZB and the QOZB has deployed all of its capital into owned value. Just to keep things really simple here, I'll put $1 million of owned property value. We'll leave leased property value blank. All right, then we'll move down to these questions here, lines 1, 2, 3, and 4 under part 6. First of all, line 1, if additional lines are needed, you can bring over the totals from part 7. You may recall that's on page 4. I'll scroll down there again. Part 7, we're skipping. We're just using one line here. Very simple structure. The 6-month test is reported on line 2 here, but you may recall we don't have a 6-month test. This is the first year of a qualified opportunity fund that was established in the second half of the year. So we would leave line 2 blank. Line 3 is the year-end test QOZ property. So we add part 5, columns D and E. Remember, those are blank. And part 6, column F. Okay, so that's column F right here is $1 million, okay? So we'll put $1 million right here. And then the final question you have to answer is, and please speak with your tax attorney or tax advisor about this, the type of accounting method used to value the property listed on the form. You need to either use an applicable financial statement valuation method or an alternative valuation method. All up for the applicable method. And then we're pretty much done here at this point with part 6. Again, if you have multiple QOZBs that you've deployed capital into, you need to list each one here, as well as you need to list each census tract here. We've kept things very simple for the purposes of this video. We would now go back up to part 2. We can fill in part 2. Line 7 asks us to enter the amount from part 6, line 2, for the total QOZ property held by the taxpayer on the last day of the first 6-month period. And the first 6-month period pertains to lines 7, 8, and 9 here. So in our case, again, we've established we're a second half of the year QOF, newly established. We don't have a first half of the year, so we can actually skip and leave blank lines 7, 8, and 9 in this case. Now, lines 10, 11, and 12 will apply to us. Enter the amount from part 6, line 3, for the total QOZ property held by the taxpayer on the last day of the taxpayer's tax year. And you remember that was just $1 million, so we'll put $1 million here. Now, line 11 is the first time that this form is actually asking, what are the total assets of the fund? And we're going to consider on the last day of the tax year, we're going to consider that we brought in exactly $1 million, and we've also deployed $1 million into the QOZB. So we'll put $1 million here as well. So we've deployed 100% of our capital, and we report that on line 12 by dividing line 10 by line 11. 1 million divided by 1 million is 100%. We put a 1 right there, okay? So you can see we've complied with the 90% asset test, but part 3 gets at whether or not you are. So part 3 down here, add lines 9 and 12. So remember, 9 deals with the first 6-month period. 12 deals with the second 6-month period, but we have left blank line 9. So 1 plus blank equals 1. Then you divide by 2, and that would give us 50%. But it does say, there's a caveat here, see instructions if part 1, line 3 is yes. And those instructions say, in this case, don't divide that line by 2, just use whatever is in line 13. Just carry line 13 down. So that is a 1. Is line 14 equal to or more than 90%? Then 0.9. And in our case, yes, it is. 1 is greater than 0.9. So we would tick yes here. And then congratulations, we're done. We're fully compliant. And this is actually a completed IRS Form 8996 for a very simple fund that successfully deployed 100% of its capital into QOZB property. Now, let's assume for a moment that things did get a little bit goofed up, though. I'll just kind of fill out, I won't change the first 3 parts, but I do want to zoom in on part 4 here for a moment, the penalty. If for whatever reason, line 14 is less than 0.9, then you need to come down here to part 4 to compute the penalty. One other thing I'll point out is that the penalty doesn't get sent in with this form. You actually wait to hear back from the IRS. They will assess the penalty and verify if there may be an exception for you for that penalty. But you can see this form gets pretty onerous pretty quickly. We're now not talking about merely determining asset values at the end of each 6-month period. No, the IRS says you owe a penalty for every month you weren't in compliance. So now you have to report for every single one of the 12 months what your 90% asset test looks like. So this is a really good incentive to not ever fail the 90% asset test, because if you do, you got a lot of work to do to calculate for every single month. I'm just going to quickly work through column A here, just to give you an example of what this would look like for one particular month if we do miss. And we'll assume, again, total assets for the fund, $1 million at the end of this particular month. So if we multiply that line by 90%, that's $900,000. And that's basically saying, look, you need at least $900,000 of your $1 million in order to meet the 90% asset test. But let's say your total QOZ property on the last day of the month is only $800,000. So then you have a $100,000 shortfall. The underpayment rate, you need to look this up. It changes quarterly. I'm going to use a 6% underpayment rate. So I'd put in 0.06 there. And if we multiply those two lines together, that's a $6,000 amount. We would divide that by 12 because it's monthly. You'd owe a $500 monthly penalty. And if that repeats for each one of those 12 months, you have a $6,000 penalty owed to the IRS. What about a more extreme case, though? What if you didn't get up to $800,000? What if you deployed zero of the capital? Now you have a $900,000 shortfall, a 6% underpayment rate. That's $54,000 divided by 12, because thankfully it's monthly. They let you divide by 12. You'd owe a $4,500 penalty for that month. So it's getting pretty steep now. And you can see it's not a yes or no. If you miss your 90% asset test, you owe this much. If you don't, you're good. It's more, well, yes or no. If you didn't miss it, you're good. You don't owe any penalty. But if you did miss it, it depends by how much you missed it. And you can see that these penalties start getting pretty high. And if that gets repeated for several months, that could be a pretty massive tax bill that your QOF would own. So that's just something to keep in mind as you progress through this form and as you continue to remain in compliance with the Opportunity Zone program going forward. So if you operate a qualified opportunity fund, this Form 8996, it is one of the most important filings you'll make each year. It's how you certify your QOF status. It's how you demonstrate compliance, and it's how you hopefully avoid penalties. All that compliance work exists for a reason. Investors who hold their QOF interests for at least 10 years may be eligible to exclude all appreciation on that Opportunity Zone investment from federal tax entirely. That's the ultimate prize. And Form 8996 is what keeps the fund in good standing long enough to get there. So I hope you found this video helpful. If you did, hit that like button, give us a thumbs up, and subscribe for more Opportunity Zone content. If you have any questions about QOF structure, the 90% test, or upcoming reporting changes, drop them in the comments below. Thanks for watching.